Mode.
Hey everybody, Preston Brent here for our Trader User Group, a weekly roundup. This is for the trading week ending May 4th, 2018. What an active week or series of weeks that we've had. Before I go into the charts that I've got, in fact, what I've got on the screen here is the E-mini S&P 500 um, daily chart. But before I go into that, just a quick recap here. The Dow was down for the week about 20 basis points, 0.2%. S&P was down about the same, about 20 basis points. Nasdaq was the only one. It was up about 1.3%. And the VIX was down 2 full points, closing the week at 14.77. The prior week was at 16.77. So even though the volatility has come down a little bit, basically the Dow and the S&P were down just a little bit this week as they were last week. Treasury yields off of the 3% level, down about 2.94%. We still got what I call the 5 T's of the markets: tariffs, technology, tightening, and the Trump tweets. But before I jump into the charts here, just a real quick recap so far on the earnings, right? We're about 53% of the way through companies reporting, more than halfway through. Slightly under 60% actually when you throw in Thursday and Friday. Of the S&P 500 companies reporting for Q1 2018. And so far, guys, our growth rate year over year is running at 23.2% at our earnings growth rate, earnings per share growth rate. That is amazing. In fact, according to FactSet, which tracks all of these numbers, more companies reporting actual earnings per share above estimates. About 79% of the companies are coming in above estimate. And if we keep at that run rate for the remaining part of the earnings cycle for Q1, it'll mark the highest percentage of companies beating estimates since FactSet started tracking all of this stuff in 2008. I mean, it's really amazing. And the sectors that are obviously reporting and leading the growth is energy, materials, technology, and financials. But if we dig in just a little bit deeper, we're seeing that companies that are reporting above estimates, it's 9.1% above their estimates. And that is above the 5-year average. I mean, it's really amazing. And in terms of sales, top line numbers, there are many ways companies can grow, excuse me, their earnings per share. One way is to do like Apple and just say, hey, we're going to buy 20 billion of our stock off the market every quarter, or 100 billion. They have like about 125, 130 billion in cash on their balance sheet, and they're using almost 70% of it to buy back stock. Really amazing. You can do that, take stock, take float off the market, and you increase earnings per share because you divide the revenue by a lesser number of shares that are outstanding. So that's one way. But you cannot engineer top line growth, and that's one that I have seen grow dramatically in Q1. In terms of sales, 74% of the companies in Q1 have beat their top line estimates. And in aggregate, they're beating them on average by about 1.7% above their estimated value. Again, setting a record that's the largest revenue surprise since FactSet was tracking this back in 2008. Really amazing. I mean, they're just blowing earnings away. And those that are leading the way, as I said, are energy, materials, technology, and financials. And then, of course, now, all of that is in context of looking at this chart here. If I were to read all of that off to you in earnings for Q1, you would think, man, the markets must be exploding higher off the lows. But if you look at it, they're really not. I mean, if you look at this downsloping trend line, we're making a series of lower highs. And we're not yet challenging our lows that were made back here, our 2018 lows in the E-mini S&P 500 futures of 25.29. That was made back on February the 6th, right? We're not doing those, but if you were looking at this chart, you would assume earnings wouldn't be that great, but they are very strong, very strong. Now, we're in the late cycle of a bull market. I'm sure many of you have heard it on TV and so forth, and everybody's saying, gee, is there any juice left in this bull? In fact, some people, you may have heard the term peak earnings, which means earnings from here are going to go downhill. But as I've told our members, and what you've got to understand, there's only two things that drive stock price on a macro perspective. earnings per share, and the performance thereof, which we're getting outstanding, and then interest rates. So the other boogeyman in this thing, or for those of you John Wick fans out there, Bubba Yaga fans out there, is interest rates. So right now we're getting a yield curve that's running fairly flat. Okay, we're nowhere near going inverted. And I will show you, and I go into more detail for our members on Sunday evenings, but just as a recap for those of you that are non-members, once we go inverted, the markets can still run up. Generally, the yield curve, once it goes below zero, gives you about a 6 month to a year heads up that possible bear market is coming in a recession. Okay, so generally in a late market bull cycle, those sectors that tend to do very strong are energy and industrials. And as I said, we've got growth being led right now by energy and materials. Okay. But energy, industrials, and healthcare, those tend to be the next sectors that start to perform as a business cycle tends to roll over. And obviously, there are exceptions to all of this, but generally, different sectors tend to outperform other sectors depending on where you are in the business cycle. And I know a lot of that is subjective, but generally, late market bull cycles, you see energy, healthcare, industrials doing very strong. And then the next wave of sectors that tend to lead is as the markets start to roll over, meaning a high has already been printed. And as you can see here, we got a 2018 high of 2878.50 on this chart. And that's not to say that we can't take it out this year. But once you start to roll over and make a series of lower highs, volatility starts to come in, then those sectors that tend to outperform are things that tend to be more dividend paying type things like telecom, consumer staples, utilities. So we're going to see possibly, if we take out these 2018 lows and we continue lower, we're going to see a little bit of a very subtle shift in sector leadership. Okay. But we're not seeing it yet. In fact, I'm on record as saying that I think we can take out this downsloping trend line and move higher. We still got a little bit more oomph left in this bull market. Okay. But a lot of it is going to depend on, as I said, those 5 T's, the tariffs. We got the delegation coming back from China. That could put a little bit of a crimp in the market. We've got some of this rotation from the technology side, one of the T's, right? And then the tightening, which is a big part with the Feds. We had the Feds come out. They pretty much, it was kind of like, to use Hillary Clinton's language, it was a nothing burger as far as the tech goes. In fact, I kind of interpreted it as more dovish than bearish, or at least that's the way the price action tended to interpret it. But then the big one is going to be the possible aspect of what the Feds are going to do. There's still about a 50-50 chance the Feds are going to hike the rates in December of this year, marking the 4th rate hike. But there's still up to about a 75% chance of at least 2 more rate hikes this year, okay? And about a 94-95% chance of a rate hike next month, rounding out Q2, okay? So that's kind of where we're sitting right now. I do believe the downside is relatively limited at this point in time. You can see this big wide support zone that I have down here just slightly north of the 2018 low. And you can see here on the chart, looking at these candles, we've got a lot of long tails on these candles, but buyers are stepping in. And you can see where it closes is well off the lows of some of these candles. In fact, we only closed one time this entire year below 25.85 right here. And that's a closing price, right? And then the very next day we shot back up above again. And same thing on the 200 EMA. You can see we've moved below the 200 EMA intraday with these long tails on the candles, but buyers quickly jump back in because we've got very strong earnings. And a lot of this is just showing a mixed reaction to what the Feds are going to do. And again, some of the tightening or with the Feds, of course, and then the tariffs or the Trump tweets, right? So this is kind of where we're looking right now on the markets. And to me, I'm looking at the 200 EMA as a key number for us, which is sitting at 2610, okay? So just understand that is where we're sitting. We're still in the red for the year, even with the big finish to the week. We finished down for the week, 2 weeks in a row. We were down about 20 basis points in the S&P. 0.2% for the week. And we're still underneath the 2018 open price. You can see we're sandwiched between the 50 and the 200 EMA. Okay. Anytime, and I tell our members this, especially options traders, anytime you move below the 50 EMA, it's a yellow caution flag for the markets. Why? Because that's how it's interpreted by price action. We're above the 50 EMA, we're below the 50 EMA. So the markets tend to get more volatile. Volatility tends to come up, which is good for option traders if you understand how to exploit an increase in option premiums. If you don't, then you could lose money a lot quicker. But you can see this downsloping trend line. I'm looking to see if we can take this back out and get back north of this. And then we got the two prior pivot highs. This pivot high here sitting right around 27.11. And then this other pivot high sitting up here just north of 27.90, taking us into 2800. So these are the two pivot highs. Now, have we made our all-time highs for the year? In other words, there's going to be no more highs for several years or a year or so until we get through a bear market. I believe right now the odds favor taking out the 2018 highs. One last hoorah before we give it up in middle to late 2019 going into 2020. But we are now going into the month of May. You've heard the saying, sell in May and go away. May, June, and August tend to be very bad months. July is okay, but basically the summer months, the markets tend to pull in a little bit. So that's just going to add to the jitters, add to the volatility that we're seeing in the market right now. But so just look at the chart here. You can see we're below the 50 EMA. We're above the 200. We're sandwiched between the two. We will break one of these very shortly. And when we break it, we're probably going to run a bit. The odds right now favor a break at the 50 EMA to the upside. If we look at the Nasdaq, which was the strongest for the week, right? You can see we actually broke back up above the 50 EMA. So a strong Nasdaq is going to lift all other markets. And you can see we never really, in this recent downdraft that we had starting in mid-April to the end of April going into early May, we never really did go below the 2018. Okay, we never went below the 2018 open price. And then we quickly got back up. You can see the 50 EMA providing some overhead resistance. But then on Friday, it jammed up. So what I'm looking for is follow through. I want to see follow through and price action from Friday. We only finished down slightly in the Dow and the S&P, up 1.3% for the Nasdaq, but I want to see follow through, which would give us a little bit more elevation above the 50 EMA and Nasdaq, obviously, and lift the others up above the 50 EMA. And if we look at the Russell also is above the 50 EMA and above the 2018 open price. All right, for the members, our members, as I showed you, I've got a couple of correlation charts between the Russell and the SPX and interest rates. And the way it looks, it shows that the Russell was due to outperform, okay, based on location of interest rates and the relative performance with the SPX. And you can see here how we found a fairly good support. Intraday, we moved below, but we closed above the 2018 open price. Folks, that shows buyers want to step in. You can see the 200 EMA. These long tails, we moved below, but buyers wanted to take it back up intraday. Okay, so that's a bullish sign. Remember, the Russell is small cap and mid cap, so when you get participation like this, we're seeing this really as in my mind, the markets want to move higher. And then if we look at the Dow, which is most affected by the tariffs, you can see the Dow broke the downsloping trend line, moved up. We're still above or below the 50 EMA. We're still in the red for the year. But again, look at the 200 EMA. We've held that fairly nicely. We're probably closest to the 200 EMA in the Dow. Okay. But again, it's showing that it wants to take out the 50 EMA. So we got the Dow futures and the S&P 500 futures below the 50 EMA and in the red for the year. We got Nasdaq and the Russell above the 50 EMA and in the green for the year. So we've kind of got these two split scenarios. And I believe that if we get follow through in Nasdaq and the Russell, it's going to lift up the Dow and the S&P, and then we'll all be in the green come close on Friday of this coming week. Okay, we still got some key earnings coming out. And because the Feds have already announced, I think on Monday we're going to get Dallas Fed President Kaplan and Chicago Fed President Evans speaking in a joint conference. So they get to talk and throw their pontificate. And obviously, whenever they speak, they can move price action around. Just understand that. And then on Thursday of this week, we get Bank of England announcing their interest rate decision. And of course, I don't think they're going to do anything because their economy, most of Europe, is coming in rather soft. And it'll give an excuse for Super Mario with the ECB not to jack rates or take his foot off the accelerator because they're spending 30 billion a month in euro on stimulus. And Great Britain is doing the same thing. So that's going to keep the stimulus train going all over in Europe from the UK to the ECB zone. And meanwhile, in the US, the Feds are still on track, 2 more rate hikes, at least. And 50-50 whether they go to a third rate hike, giving us 4 for the year. I think they're only going to do 2, personally. And of course, if we look at the VIX, you can see here with the VIX, we've moved back down. We're sitting almost right on the 200 moving average, which doesn't say much because 2017 kind of really pushed all the averages of volatility down because very rarely did we get over 11 or 12 for the entire year for volatility in 2017. 2018, we started off with a bang the end of the month. But we're kind of in that zone between the yellow zone and the green zone of volatility. It's not going to take much of a downward move to move VIX back up here because it's a little bit more sensitive to downside action. And I do believe we've got enough geopolitical risk coming up, mainly in the oil markets on May the 12th, when Trump is going to say we're in or we're out. And if we're out of the Iran deal, that's probably going to add another $3 to $5 to the oil price over a 5-day period, 6-day period. But it's going to depend on how we get out of the agreement. It's not just, hey, we're out, and then all of a sudden oil is up the next day, $3 a barrel. It's a little bit more complicated than that. Okay. For our members, I'll go through it in a little bit more detail this Sunday evening. We got some oil trades on that are working out for us. So, but that's just something that we got to look forward to over the weekend. That would be, so most oil traders are going to be prepping for that on this Friday, May the 11th, because the decision is coming on Saturday. At least that's the way it looks. It may be telegraphed the middle of the week. Right now, the market is forecasting about a 75% chance he's going to bow out. All right, so that means some of the price is already into the price of oil. But that's another geopolitical risk that's sitting out there. Treasuries, relatively flat on Friday. As you guys know, my target was 140. I've had this on the chart here for quite some time. My target is around 140. And you can see the price here. We almost hit it. We hit 141 and 17 ticks. We're up in this area here. I would be more willing to sell bonds than buy bonds at this area. But if it's willing to go higher, I'll be more of a seller of bonds. Up in this area here, we were a seller of bonds because I knew the chart. There was just too much downward pressure on the bond market. The only way the bonds are going to come back up and challenge this area here is if the markets just completely come undone. I don't think that's going to happen near term. Just the earnings are too strong. The only way the markets are going to come undone right now, and by undone, I mean take out February lows and continue lower, is that we've got some geopolitical action where we just, Trump fires off a massive series of tweets with China and the trade tariffs get worse. And then we pull out of Iran. There's just a number of things that can drive it. The charts, however, irrespective of those geopolitical risks, would indicate that bonds are going to go lower. Interest rates are going to go slightly higher. But I think we're going to be in a consolidation zone. I don't think bonds are going to go too much lower. I just think we're going to stay relatively flat in interest rates. Because if we look at the 10-year interest rate right here, you can see we hit my target perfectly. My target was, I missed it by 1/100th of a basis point. Or 1,000th of a basis point. So I was calling 3.036. We hit 3.035. So just call that for all practical purposes, we hit my target. Now we're coming back in a little bit. I think we're going to chop around. I don't think interest rates are going to come back down to these lower areas down here around 2.7, but I don't think we're going to get back up here in the near term. I think we're going to stay in this wider range. And volatility across most of the bond market is relatively low anyway. I think we've just been kind of in a range-bound mode. You can see here how we were when we had that big fast move in early February, which really moved the markets much lower. It kind of gave the markets a heart attack or a stroke end of January going into February because we didn't know what high volatility was, all the way leading up from January 2017 to end of January 2018. Then we got introduced to volatility again. But you can see here from beginning of February all the way through to April, almost the end of April. So you had February, March, April, almost 3 months of just a range bound move. Then we move way up here, hit my target, and now we're going to be in a chop again, I think, for a couple of months through the summer months. Okay. If the markets do kind of peter out a little bit, I don't think we're going to see any really strong downward action unless we get a geopolitical event takeover. So that's kind of what I'm looking at here. Currency wise, well, it's a home run for us in the dollar. I was talking about the dollar hitting a consolidation pattern here. You can see this long consolidation pattern. I said it's going to break out. My target for the dollar was originally around 90. The dollar index was around 90. We overshot it a bit, but you can see where it just provided overhead resistance until we finally broke out. I said if we break out, we're going to move back up and challenge 2018. We did, and we made new highs on Friday for the dollar. I think the dollar is going to come up and challenge 94 area. All right. So obviously, if you're not paying for the market data feeds for ICE, then the best way to trade the dollar is through or either in Forex, or you can use the Euro futures. And the Euro futures obviously are going to go in the opposite direction. So we broke down, and we actually, and let me just move this over here. We actually made a new 2018 low for the euro, just like we made a 2018 high for the dollar. And I can put this line in here to just show you where it's almost the same. We just made a slightly lower low in the euro, and this was the support point. And once this broke, all hell broke loose. And now we're down here. This is going to be good for European companies because we were seeing too much of an extension of the euro versus the dollar, so it was just ripe for a pullback. So for some of our members that I was recommending that you either go short euro dollar or go long the dollar, one or the other. And it set itself up for like 4 or 5 months. It just built that base. And once it broke out the US dollar, I'm talking about the dollar index, it was a good trade. Now, there are other things that we're looking at there too, but I will not go into them. We'll talk about them with our members. If we look at gold, gold here is bouncing again off of my huge support point, which is right around the 1300 area. Okay. You can see ever since we got in, this is January 3rd right here. That was the open price of gold for the year. And you can see, if I blow it up, you can see kind of where we're sitting. And we bounced perfectly off the 200 EMA. And the minute we broach the 50 EMA, you can see the upward vector of the 50 EMA, the upward vector of the 200 EMA. The 50 EMA has now got a downward vector. The 200 EMA has got a slightly canted upward vector. So that just means more chop for gold. Gold is not ready to go anywhere for a while, guys. You can see up overhead, I've got this 2016, 17, and 2018 highs. That's huge resistance here. I've been telling folks that when we get up in this area here, if you want to swing trade it or day trade it to the downside. If you get down here, it's better to trade it to the upside. It's going to take a lot of effort to break 1300 going down. Okay. If we see interest rates break out, and we see the dollar break out, because this is also, remember, a stronger dollar is weaker gold, and we see the dollar continue to break out, then we're going to break down on the gold market. Gold trades technicals very, very well. Okay, so if you are a good technical trader and you can understand charts very well, then it ups your edge in trading the gold market. Same thing with silver. If we look at silver, you can see here we tried to break out of this triangle. And we couldn't. We just cannot get enough oomph to get leverage to break out. And then we come back down and we test the upslope in line again. And we're still back into this mode again. We're not ready for gold and silver to make its run. When the markets start to roll over and it looks like it's going to be fear in the markets, then these guys are going to start to run. Right now, we're nowhere near that. Oil finished the week. Look at this, guys. We made 2018 highs for WTI, West Texas Intermediate crude oil, 69.93, almost 70. Remember my target. I put this target up here in early March, right around $72 a barrel. Okay. Once we hit up there, I will be more interested in shorting oil rather than going long oil. Oil right now has got $2 to $4 of risk premium already built in. And should we back out, and we back out in an ugly way of the Iran deal, it's going to move it back up over my target, maybe around my target area. And then it's going to cause some demand destruction in oil, which is going to back oil off. So if we have a nice move up, taking the contra position here, maybe selling a little bit, would make some sense. Okay. So that's a little bit of what I'm seeing with oil. And if you look at gasoline, same thing with gas. I mean, we're near the 2018 highs. Right in this area here, when we broke, I was suggesting we need to get long gasoline. Okay. And that was a humongous trade in the futures market. Okay. You could see, and let me just adjust these because these are the new areas here. But anyway, if you run a regression channel down here, it was such a tight channel, right? As the markets really came undone in early February of this year, everything sold off. I think this was more of a sell-off to meet margin calls elsewhere. And then once that was finished, it was just nothing but a counter reaction and coming back up to match the levels that were more palatable to me. So you're going to see this show up at the gas pumps over the summer months. I guess the timing is bad for gasoline for summer drivers, but you're going to see it show up at the pumps with higher gasoline prices if you haven't already. So that's kind of where we're sitting here. And then natural gas, well, short term, nat gas has just been weak. There is a ton of supply sitting out there. And if I were to market, which uses a combination of Gann and Fibonacci, right? It's showing that gas can come down here around the 2.4 area. So I'm looking for natural gas to come back down into this area here. If we can hit this area down here, then I'll be interested in selling some puts out of the money and trading nat gas to move back up into a range again. All right, so that's kind of what I'm looking for. Meanwhile, in corn, we got a great trade going on in corn for our members. You can see corn had this huge move off, broke out, ran right through my target. It'll probably pull back to my target, sitting a little bit over $4 and a penny a bushel. 401 6/8 is the way you read it, or 2/3 of a penny. So $4 and a penny and 2/3 is the way you'd read it. But you can see here where we've just had this nice run. We're making some good money in our corn trade. We got some other trades that we're going to set up here. The nice thing about corn and commodities is it goes, it's a great allocation model against just playing all equities, right? Because the equity market can be crashing and corn market can be doing very nicely going in the other direction. All right, everybody, that's kind of where we're sitting right now. If you're not a member of our group, I highly encourage you to come in and check us out. We're doing very well. We got an international audience. Also, we're running our Option Masters program. We're getting new people signing up all the time. If you want to dramatically improve your knowledge of options, we're going through that as well. So that's kind of where we're sitting, everybody. Have a great weekend. And members, I will see you this Sunday night for our weekly market watch. Take care, folks. Have a good weekend. Ciao.